other than collapse. So in the 2030s, in my opinion, we default on our debt. I hate to say this, but because I could be dead wrong, but just looking out there in a broad picture, I can see the potential. And again, this is not a forecast because I can't know that. I can easily foresee 50% unemployment rate or higher, no unemployment system, no welfare system, very limited Social Security and Medicare and Medicaid, if any, basically no government supports, in other words, and half the people in the country out of work.
Welcome to the Rose Show podcast. Thank you so much for joining us. I'm so excited to be here with David Hunter. He is Chief Contrarian Macro Strategist with Contrarian Macro Advisors. He has had over 48 years of success in the financial markets. You're known for your contrarian and cyclical views on the economy and the markets. So no herd mentality here. Who needs AI when we have David Hunter? How you doing today, David?
I'm good, Rosanna. Thanks for having me on. This is great.
Absolutely. We're so honored to have you. I love your discussions about market cycles and pattern recognition. You know, you have an excellent track record, and I want everyone to know that. You know, there was a very atypical time period during September 2020 and October 21, and you correctly projected the market's movements. So very impressive. So I'm so excited to get into your current forecasting for what we have planned for this year into next and maybe even the next few decades. So, you know, you're the voice of reason in unreasonable times, it seems. So I like to talk about macro and markets. And I want to go into your contrarian view for the markets, the reasoning behind it, understand the why, and break it down for people. And then we'll talk about the cycles and macro behind it all. And most importantly, the opportunities that are presenting itself and how we can prepare. I mean, what's the point of having great information if we don't prepare accordingly? So I want to get into all that as well. So let's go over your forecast, the overview, and what you're foreseeing. We're nearing the end of this 41-year bull market, and it started in 1982, and you expect a massive melt up. And it should be going on until about, I think, October 23, correct me if I'm wrong, and then followed by a global bust that will be the worst since the 1930s. Did I get that about right?
Pretty much, yes. The secular bull market that started in August of 82 is a view I've had for quite some time. A lot of people disagree with my timing, but I use that as the start date for the secular bull market because that's really when disinflation kicked in. We had the hyperinflation in the early 80s. You know, Volcker came in and with a lot of work got it down, and it ratcheted down over the last, 4 decades. And it was that bringing down inflation and bringing down interest rates with inflation, or interest rates follow inflation down, that leads to higher price earnings multiples. It's kind of an inverse relationship. And so really the wind at your back that whole 40 years, or most of that 40 years, was the fact that we had disinflation, and with disinflation, lower rates, and with lower rates, higher price earnings multiples. So we went from a single digit market multiple in 1982 to, obviously, we've gotten up over 20 in the last few years. So, that's a big part of that long bull market. Obviously, you've had earnings come along with that. But I think we're at the end of that. I think this is the last hurrah before we begin a secular bear market. And so that's all important context, I think, to understand why I talk about a melt up, because melt ups are not something we see very often. We had a melt up in 29 before the crash, 1929. We had a melt up in the NASDAQ in 1999, 2000 with the dot-com bubble. We probably had a you could describe the Nifty 50 1973 bubble as a melt up because it had a big move there in a short time. Melt ups are a parabolic move at the end of a cycle, is how I describe it. And we had a melt up, by the way, in 2020, 2021, when the market doubled in 21 months or more than doubled. I get a lot of people on Twitter saying either the melt up's already happened, and I agree we had a melt up then, or you've been calling for a melt up for a long time. When are we going to finally see it? I said, well, this isn't one melt up. We had a melt up in 2020 and 2021, and then we went through a short bear market last year. And we have one final leg in this secular bull market that's going to be steeper than 2020, 21. So it's hard for people to understand that because melt ups are rare, and we're going to have two in a 3-year time horizon or time period. So I think it's easy to get confused by that and think it's we're still waiting for that melt up, but we had one. And would I have foreseen that we'd have 2 in 3 years? No. But you go with what you see. And what I see in my work is that and I've been saying this, as you know, for much of the last year, that we will end this thing with an even higher high and a final parabolic melt up into a top. So I think that's where we're at. Obviously, we saw a bottom, or I think we saw a bottom last October, and up until very recently, most people disagreed with that. Most people thought we'd see lower lows, that this was just a bear market rally. You're just beginning to see a shift in investors and in pundits to beginning to realize this is a new bull leg. This isn't a bear market rally. This is a bull market. So that's the beginning. It's still, they're kind of on the edge. They're kind of riding with the momentum right now. Some might be throwing out a return to the old high of 4,800 in 2021. But for most of them, they still are not ready to jump on board and say this thing's going off to to the races to higher highs. So they're going with the momentum, but the skepticism is still underlying. So that's good. I believe, obviously, that the melt ups this year could be by October. I mean, I've been kind of using that as a time frame, end of summer or early October. I think that's very possible. But as I tell people, trying to time the end of a 41-year move, I could be off by many months, and certainly look for this to happen faster than it has previously. So I'm not so worried about exactly when it ends, but I do think it's coming, and I do think once you get into that true parabolic, you're going to cover 1,000, maybe even 2,000 S&P points in a matter of a month or two. So it can happen very fast once it gets going. The hard question to answer right now is, are we in the melt up and where it's going to just keep feeding from here and without any big pullbacks, or are we going to see once we get up to say 4,650, 4,700, maybe even 4,800, are we going to have to take a rest and see a consolidation that might be 5 or 10%? And I can't answer that. I think we're just going to have to watch this next couple hundred points and see what happens. It's looking a little bit like pullbacks are going to be short-lived. They might be 5% pullbacks and not 10, and they might last a week or two, because what we're seeing is in these recent pullbacks, the investors get bearish pretty quick. I mean, there's an underlying lack of conviction in this rally. I mean, they are jumping on it because they're worried about missing it, FOMO's kicking in. But on the other hand, the minute it turns south, out they come again, so, starting to talk lower, not necessarily back to new lows, but they get nervous. So that's a good sign. That's what I call the wall of worry that will keep sustaining the rally. If you get everybody bullish and their convictions are bullish, they've already acted on those convictions, and you can top out. As long as people are still nervously in there, there's plenty of fuel for, much higher.
Excellent points there. Yeah, you need the bears to help fuel that bull market. And that's absolutely important. The fear of missing out, FOMO, is definitely adding to that fire. Excellent points you made there. It's not about pinpointing the exact time. We can't time the market, but knowing that it's coming. And that's key. And that's how we need to prepare and find these opportunities. Before we get into the exact levels that you're seeing for the commodities markets, I want to talk about the indexes, the dollar, and what you're foreseeing with that. We're going from a secular bull market to a secular bear market. But how do you account for the 2000 bear market and the massive 2007, 2008 bear markets in there? How do you account for those in your thesis?
Sure. So basically, and that's why some people disagree with where I start this thing from, is we typically a secular bull market means higher lows and higher highs each cycle. So I got to reconstruct in my mind, but I think it was in the 2008-9 where we undercut the lows from the previous cycle. So some people think that that ended the secular bull market, and that this is a new secular bull market started in 2009. Obviously the Nasdaq got hit very hard in 2000. I tend to look at the S&P for overall market judgment, but and the broader market didn't get hit nearly as hard. So again, I view 2000 as pretty specific to the tech area. Obviously got hit very hard and was a melt up, and then called a meltdown or a crash or whatever. It was pretty serious bear market, but the overall market basically still had your higher lows and kept going. So I kind of look at it both technically or from a chart standpoint in terms of those higher lows, but also from a standpoint of the macro and what it's all the same theme going all the way through, in that we had ever higher PE multiples because inflation was beaten. And I mean, we went from a 15% 10-year to a 0.4% 10-year in that 40-year period. By early 2020, we had gotten down to that 0.4% on the 10-year. So it was all, again, we had coinciding with that secular bull market, a secular bull market in bonds. The bonds had that great run too. So they are parallel. And again, people can have a different opinion and use other dates. I could even date this from 1974 because that was a lower low, below 1980 and 82. I could use that, except again, I feel that disinflationary trend was very important to the start of a whole different environment where you could buy indexes and just sit in those indexes and outperform most managers because an awful lot of the return was coming from the multiple expansion.
Excellent points there. I love your thesis. I think it makes a lot of sense. And the way you explain it, starting in 1982 in the secular bull market, and what you're saying is it's going to be widespread. That the bear market that's coming, the secular bear market, is going to be more widespread than the 2000 and 2007 and 8, which seemed to be concentrated. As you said, it was like technology. It was that .com era. So excellent points there, David. Thank you so much.
If I could clarify a little bit, because a lot of investors have, I mean, these are concepts not a lot of people know. I mean, professionals know them, but the difference between a cyclical bull and bear market and a secular bull and bear market is that a secular, I'll talk bull market, but bull market contains several cyclical bull markets. So, 1974 to 1980 was a cyclical bull market. 1982 to 19 90, I guess, 91 was a cyclical bull market. 1992 to 2000 was a cyclical bull market. They were all within that secular bull market. 2008, 2000 to 2000, 2003 to 2008 was cyclical bull market. 2009 to now was a cyclical bull market. So there are, and they each were, those cyclical peaks were followed by cyclical bear markets. A secular bear market is a different thing. It's when you no longer go to new highs each in the next cycle. What you run into is, so I'll use just my numbers for now. I'm expecting the S&P to get up to 6,000 or 7,000 this year into a secular top. From there, I'm calling for an 80% bear market. That's a cyclical bear market, but the worst bear market in the post-World War II era, the worst since 1929 in terms of a broad bear market. But it's a cyclical bear market. But when we rally out of that bottom, so let's say we go to 7,000 on the S&P. If we get, and again, my numbers aren't going to be at all precise, these are just guesstimates of where we go. But if we go down 80%, that takes you to 1,400 on the S&P. You come from 1,400 in the next cyclical bull market, you could triple or quadruple that 1,400 and still not get anywhere near 7,000, right? So 14 times 3 is 4,200. So well below 7,000. 1,400 times 4 would be 5,600. That's still well below 7,000. So that's where I think we top out in that next, following the bust, that next several year stock market rally or bull market, and then go down, back down, and you just don't get back. I don't believe you'll get back to the 2020, assuming we make the top this year, the 2023 high. I don't think we'll get back there in the next 2 decades. And we may not get back there for longer than that. So that's what the secular bear market is. Doesn't mean there aren't opportunities in the cyclical bull markets within that bear. It just means, we may be looking at a top that's going to be long standing and take several decades to get back to. Again, there'll be new leadership in a new bull market, new cyclical bull market. Every cycle has different leadership. This one was led by technology. It's been a great run for particularly the FANG type stocks, the big cap, but also small cap tech has done very well in the last, since 2009. Cyclicals have not done so well. And what I think you're going to see next cycle is a huge commodity cycle. So, it'll be different leadership. The techs will be digging out from the other thing to remember is that because they've done so well, they're heavily weighted in the indexes. They're owned by everybody. So whether it be Apple or Google or Meta or Microsoft, and list goes on, they've done so well that people keep buying them. And the professional investor wants them in their portfolio because of that. They are performing. The small investor wants to be on board that. So they've been accumulated over a decade or more. And when they go down, there's going to be a lot of people trying to get out of them because they're going down a lot. And so because they're so heavily owned, there's more pressure on the downside because there's more volume from those stocks. They're more, they represent a much bigger weighting in the S&P or in the indexes. So they take a bigger hit. And it's called distribution.
Mm-hmm.
They get distributed out. And when we turn around at the bottom, let's say later next year or early 2025, these stocks, the people who bought those on the way down there's going to be a lot of overhead resistance, what they call overhead resistance, that you've got to get through for them to have the next move up. Since they'll get, they'll come, they've had a long run up, they'll have a long run down or a steep run down. And coming back up the other side of the mountain or coming back up in the next cycle, you just, every time you lift your head, there's another group of investors that say, oh, I'm getting my money back, I'm getting out. So they have, they'll have that. Whereas the new leadership, once it breaks out to new highs, has no overhead resistance, and there's, clear sailing ahead. There aren't big waves of selling as you move back, to ever higher highs. So that's the nature of every cycle. And that's why you have new leadership, and why new leadership can, have many multiples of their, returns can be, doubles, triples beyond. Whereas the stuff that has huge overhead resistance just kind of keeps fighting through that. If you go back to the 2000 bubble in tech, it took 10 years for tech to get back to its old highs. And this time it'll be much longer, I think. But it took 10 years because of that resistance, that having to fight through lots of supply of old investors trying to get their money back. They lost money when it sold off because it went down 80%. The NASDAQ went down 80%. And at different levels, there was another group of investors trying to get their money back, and it come out. And that's a human nature, is rather than say, oh, it's a new cycle and I'm going to ride this because I still like it. It's like they got beat up so much, they're so glad to just get their money back. They didn't think they were going to see that. So it's kind of, in technical, as you probably know, in technical world, you break above resistance. And technicians like that because they know there's probably going to be a run, and up until you get through that, it's a fight. But the real point in all of that is that the next cycle doesn't mean, just because it's a cyclical bear within a secular, a cyclical bull within a secular bear, doesn't mean there won't be some really good opportunities, because there will be.
Absolutely. There are always opportunities. And that's how I like to look at it. When you compare, thank you for that explanation. I think most people need to understand that cyclical versus secular, key concept. I like to think of them as the cyclicals are like smaller, shorter cycles within the larger, greater secular cycle, right?
Right.
And so, okay, important points here. I'm going to supply and demand. The market is complete. That's what makes up the market. And excellent points. The overhead supply, and these cycles are based on human emotion, human nature. And so, as people are exiting the door, you keep going down that supply, and there you go. And the demand's not there. Everyone wants out, so it goes down fast. And so, excellent point there. You say how we're moving from more technology over to a commodities, like a big commodity cycle. I want to understand that key concept and what you're seeing. So we're going technology to commodities. Tell us about that.
Sure. So again, this comes back to a lot of it to the economy and macro, but we have spent, as we talked about, it was a disinflationary cycle for the last 4 decades. That really, we moved from a very highly cyclical industrial economy back in the early 80s to an economy that gradually, but over the last 4 decades, has become a service economy, primarily, more consumer oriented. And that was what that big cycle, that whole secular cycle was really a shift from being an industrial-based economy to one where services kind of predominated. And so what we've done is, in that process, a lot of our heavy industry got farmed out to China and elsewhere. A lot of our industrial jobs went away. And so what's happened is we've and this happened, it's here, but it's happening around the world, that services kind of, except for China, services kind of became a bigger part of Europe, a bigger part of Canada, et cetera. What's happened in the process is, industrial has underinvested because it wasn't, the US obviously is the big economy in the world, and China's catching up, but we kind of set the trends. We weren't demanding as much in terms of all of that, and certainly in the US, auto industry went elsewhere. We have some, but not nearly what we had 50 years ago. So we didn't demand all those raw materials, and the companies started to rationalize their capacity and invest accordingly. So there's been a lot less effort to build new plant equipment, and again, around the world you have underinvested in commodities because the world became much more consumer driven and much more service driven. And now all of a sudden, part of it was in the process before this, and part of it the pandemic kind of brought along. But what you're seeing now, not just in the US, probably more so in the US than anywhere, but is this reshoring. And the idea that, hey, we just saw in the pandemic that we, putting all our eggs in China's basket and depending on them for supply was problematic. Geopolitically, it was problematic. We didn't control our supplies. There were issues about lots of things, getting the supplies off the dock, importing things and then, getting them into the stores, etc. So we're now understanding that in a lot, and of course in semiconductors and things, there's lots of friction there that says, we want to be able to control our supply a lot more than we're seeing we can right now. So there's big movement towards reshoring, which means bringing capacity back into the United States and recognizing, even militarily, that it's not a good idea to be so dependent on some economies and countries that aren't necessarily our friends all the time. It's not necessarily good militarily either, because if we ever had to ramp up for a war, we couldn't do it. What we did in World War II, we couldn't do today because we don't have the plant and equipment we had then. So I'm not saying that's all going to happen overnight, but there is a recognition that we went too far, and we could spend the whole session on the bad decisions that have been made by policymakers in the name of cheaper goods, etc. But just to suffice it to say that we are going to move more back towards industrial, and a lot of that reshoring is going to happen in the next cycle. Add to that the fact that you're going to have, if I'm right, you're going to have a global bust, which I define as something that's bigger than the recessions we've experienced in the post-World War II era. Will feel a lot like a depression and have some of the characteristics of a depression, but occur within the time frame of a recession, so maybe 12 to 18 months. So it's pretty damaging, but not stretched out over a decade. In that process, because of all the leverage in the system, and again, this is worldwide, but I'll focus on the US, the Fed is going to be, and the policymakers, both fiscally and monetarily, we're going to be forced to go back and just pump money and expand fiscal very aggressively, because the bust is going to mean bank failures. It's around the world. It's going to mean a lot of involuntary debt liquidation. And there's only really one policy tool that moves quickly when you're being, think of 2008-9, when you're being faced with a systemic crisis in the financial system. You can't sit back and say, well, let's kind of think about this for a while and make sure we come up with policy. You got to move fast, and we saw that in 2020. You had to respond pretty quickly, or all was going to tank. So we're going to see, I think, from the Fed, probably something on the order of 20, in my estimate, 20 trillion in new money in QE. And so our balance sheets currently, Fed balance sheets currently a little under 9 trillion, got up to 9 trillion last year. And they're pulling some out. in 2008, prior to the crisis, September of 2008, Fed balance sheet was 875 billion. That's the largest it had ever been in the history of the Fed, going back to 1919. So that sum total of the Fed through all those years was 875 billion. We weren't even a trillion.
Mm-hmm.
We're now looking at a Fed balance sheet that's close to 9 trillion. And I'm telling you, in a couple of years, it's going to be 30 trillion
Mm-hmm.
because of the response during the bust. That 20 trillion, and of course, we're hearing from the Fed, and certainly lots of Wall Street people are cheering them on, that and agreeing with them. The Fed will never go back to being, that printer of last resort. The Fed's not going to go back to that, QE to infinity type approach that they took. The Fed's trying to get the market to understand they're not going to be the Fed put anymore, holding the market up, backstopping the market. It's all nice for them to think that, and I think Powell believes that, and lots of people on Wall Street believe that. It's inevitable, in my opinion, and particularly if I'm right about what's coming. It's not, they have no choice. When the system is imploding, and all around them is, the economy is imploding, they can't sit back and say, well, theoretically, if we do this, it's going to cause inflation down the road. We're not going to repeat that mistake. They're going to be dealing with the here and now, which is going to be disastrous, and they're going to be printing money like there's no tomorrow. So we'll see in the course of 2024, 25, as much as 20 trillion in new money. So like I said, we saw 5 trillion in 2020, 2021. That was unheard of. We weren't even a trillion total back in 2008. So to go from that and now all of a sudden say it's going to be 4 times that amount. I mean, I know it's we all throw around the numbers and it's easy to talk about. You can't wrap your head around $1 trillion, never mind an expansion of 20 trillion. I mean, it's just, I don't think people really understand the magnitude of what that is saying. And it's an estimate on my part, knowing what I think I know about what's coming, of what it's going to take to save the system. And again, it's not so much our banks, because our banks got religion to at least some extent in 2008-9. We were in a crisis, and the U.S. was, the banks were highly leveraged, and they paid a price for that, both being forced by the policymakers and also from their own learning curve. They're much less leveraged today. And so we are not nearly, our banking system is not nearly the high risk banking system in the world. Europe's in rough shape. Canada, unfortunately, didn't learn our lesson, and they were in good shape in 2008. They're more like we were then. Now, Australia's got, big leverage, and real estate dominates their banks. So there's other parts of the world. Asia obviously has leverage beyond anybody's. So there's parts of the world where the risks are greater than here, but the world's so interconnected today.
Mm-hmm.
The counterparty risks are all there. The big banks are all dealing with one another. So it's going to be a worldwide systemic unwind, or what I call bust, and financial crisis of a magnitude we didn't even see in 2008-9. And so that will be responded to by every central bank in the world, printing money like there's no tomorrow. So what we do, you'll see proportional being done by the ECB and the Bank of Canada, and even People's Bank of China. So, Bank of Japan, etc. So it's, in my view, it is inevitable. I don't think they'll have a choice. And the problem is there's a lag to when you print. So the reason it'll be that large is because they'll print and it won't stop the free fall. They'll print some more and it's still going down. They'll print some more. And so because of the lags, by the time they recognize that they did far more than they needed to, you've you've again, with a lag, jump started a new cycle that's going to become the biggest inflation cycle, far bigger than 1980, I think, in terms of, I think we'll easily see 25% inflation by the end of the decade as an annual inflation rate. And I think interest rates will easily retrace what they were back to what they were in the early 80s. So 15% long bond. T-bills were 20%, 21%, I think was the high, if I remember. I actually was there. I'm one of the old dinosaurs that was there then, but I think it was 21% was the high in T-bills. I assume they're going to go higher than that. So you could see 25% T-bill. I mean, those are numbers that are just mind-boggling. We've spent 40 plus years bringing inflation down, working really hard to get inflation down. And, some of it's unavoidable, some of it's very bad policy decisions, but we're going to be right back in that place again. And it's, so that money, that 20 trillion, again, I don't know whether that's an actual what it's going to be or not, but that's just to give you an idea what I think it could be. That will cause an inflation cycle and jumpstart an industrial recovery. Again, the consumer will come back, but he's going to be hit hard in this, so he's going to be, kind of a laggard in coming back. But the industrial is going to lead the recovery, and that means, part of it is going to be certainly alternative energy and EVs and all of that that's being pushed by the Biden administration. But some of it's going to also be, reshoring. So we may even bring steel mills back here. We may even bring, you're going to see, I don't know if we'll see machine tools and some of that. You'll see, it's going to be heavy industry coming back to the U.S. Probably not in exactly the same form. Won't be the same type. But the steel mills have new technologies, things. So there may be, ways they can build it cheaper. Semiconductors can be, it's already started there, but you can see more plants there. We've got a risk having so much concentrated in Taiwan. So manufacturing of semiconductors coming back here, et cetera. That all demands resources, raw materials. And again, we're not going to be the only ones doing this. It's going to be worldwide. There's going to be an industrial resurgence. I don't know what, I can't predict what China's going to do. They've ramped up and they have, the kind of production they have in all these heavy industries is mind-boggling what they ramped up doing. So they may have to rationalize, and they're going to get hit hard by their leverage and by the downturn. So who knows exactly what happens to, do some of their older plants get shuttered, and are we going to have to pick up some of the slack, and Europe pick up some of the slack, and other parts of Asia pick up some of the slack? I think that's probably part of it. India will certainly be a new growth area for new industry. So it's not going to be just here. It's going to be going on South America. It's going to be going on everywhere. And because we had this long period where industry or where raw materials were not in that kind of demand, the searching for raw materials it's harder to find. The prices went down, so it wasn't economically viable in a lot of the areas to find the raw materials. We're going to, and it takes a decade sometimes to develop new resources. You're going to have this, because of money going into systems so powerfully, you're going to have a ramp up in industrial activity around the world over the course of the following 5 years. That's very rapid, and there's not going to be the resources to meet that demand. So you have excess demand, and very excess demand relative to what recent years have been, even recent decades, and constrained supply because of what's going on over the last 40 years. And all of a sudden, the only thing that can happen is prices go through the roof. It's the price of the resources. If you have tight supply and demand growing, the only thing to balance it, price goes up. It's economics 101.
Mm-hmm.
So you're going to see, and we can talk about, to give some examples, I'll use energy just as the most obvious. And in energy, you can add on to that, the climate change agenda, ESG. It's discouraging our fossil fuel industry from doing new exploration and development of resources. So that's also an issue. I mean, it's really parallels what goes on and what's going to go on in steel and copper and all the metals, et cetera, base metals. But energy is an easy one for everybody to understand because it's so much in the news and in the forefront these days that we're trying to move to an alternative energy. The agenda is there worldwide, certainly led by the U.S., and it's discouraging the fossil fuel companies from investing. They're saying, well, we don't know what our future is. We're being told we're going to be phased out. It's not going to happen as fast as everybody's, telling you it is. But they know that the future is going to be less fossil fuel. So they're kind of not putting the money into looking for new oil fields and gas fields, et cetera, to the extent they could. And then all of a sudden you get this huge infusion of money, and a year later, the beginning of a big upcycle in the economy that's led by industry, and oil can't keep up. The industry says, I need more energy, and they're not going to get it from wind, and they're not going to get it from solar. They're going to need it to come from gas power, natural gas powered and oil powered electricity, and it's not there. So prices go through the roof. And I believe oil in the bust because demand's going to get hit very hard by the worldwide economic bust. So I believe oil next year can get down as low as 30, but I believe by the end of the decade, crude oil will be up as high as $500. So, I mean, that's the kind of commodity cycle I'm talking about. And, copper will be in huge demand, and that'll go through the roof, and, aluminum and steel, et cetera. So it's really across the board. And even ag commodities, it's funny how it works that way, but it's not as driven by the economy. But I think even the ag economies are going to be multiples of where their prices are today. So it's going to be across the board, and that's part of what's going to be driving the inflation. And then what feeds into that, obviously, is wages have to start rising to keep up with, or try to keep up with, the huge rise in cost of living and cost of goods and services. So wages will begin going, and you're just going to have a huge inflation cycle.
Wow. You are quite a thinker. So well thought out and explained, David. This is amazing. It makes total sense to me. I mean, the current economy we've been in, the consumer driven, has been unsustainable. Massive debt. Growth has been fueled by all these negative rates, free money that we've had. Money's gone towards riskier assets. At some point, it just becomes unsustainable, and there's going to be a shift. And I do believe reshoring, shifting back to industrials and, real assets. We need to have these resources, and it all goes down to supply and demand. Nobody's looking, nobody's thinking of it. You are certainly, Contrarian is, but there's going to be massive demand, and the supply is not really going to be that high. It's going to be about the same. And so people are going to be scrounging around looking for these resources. And that's where you have increase in pricing. Because as the demand goes up significantly and supply is about the same, we all know economics 101, price goes up significantly, which is exactly how you lay out in your case. You mentioned the Fed, and I definitely want to go into the Fed. I'll just mention lags. Lags are the most important concept for everyone to understand. There's a lag 18, 24 months on most data, and the Fed is so backwards looking, and I feel they're just behind the curve. Like right now, they're over tightening based on lagging data, and it's like they're leading us into this recession, this massive tightening of the money supply, and they're once again, in my opinion, going to be behind the curve. It's inevitable that they're going to have to provide all this massive stimulus. Let's not believe what they say. They also said that inflation was transitory, and and they said they weren't going to raise rates, and now they're in this period and they're saying they're never going to go back to the QE. But like you said, they're going to be forced to. They're going to have no choice but use the tools available to them, which is lowering the Fed funds rate and increasing the money supply. And I totally believe, very plausible, that this debt is going to be increasing, even though these numbers seem so massive, 20 trillion, very possible, because when we get to that point, they're just going to have to do what they have to do. And then once again, like you said, lagging data. So they're going to overstimulate. And then we're going to be in that period, like you said, that's going to last decades. Makes total sense. And I think it's very important for people to understand that. So
Yeah, I've been a Fed watcher for 50 years, my whole career.
you know them,
It's
Volcker
pretty
and
much,
everyone.
and I always said before this, G. William Miller, who was the Fed chairman back under Jimmy Carter back in the late 70s. And I don't think people really, it's different when you read it in the books versus living it.
Yes,
And
absolutely.
I was there then, and it was very obvious what he did at the time was, we were beginning, it was during the period when oil ramped up. We had the oil embargo in the 70s. And so what he did was monetize the oil, because it went, we had this huge jump from where it had been contained forever. And then OPEC developed a cartel and said, hey, we're going to hold you hostage. So oil ramped up, and oil was such a big part of everything that it caused, whole inflation cycle. But what G. William Miller did was, in an effort in the short run to kind of make things smoother, he monetized that oil increase, and I knew G. William Miller historically because I was the in-house equity pension manager at Textron in the early 80s. G. William Miller had been chairman of Textron. When I got there, he was gone and was, had been at the Fed by then. But he was he's a financier. He wasn't an economist. But Carter picked him because he was on the Boston Federal Reserve Board and said, "Oh, I need a Democrat to head the Fed," and there weren't that many economists, so he grabbed him. Smart guy, he was a really smart guy, but he wasn't an economist and wasn't a Fed expert. And the big mistake he made was during that when inflation was starting to ramp up in the late 80s, late 70s, when that led to Volcker coming in and spiking rates. William Miller printed money. Interest rates were rising because inflation was rising. He made the mistake of thinking, I'm tightening because rates are going up. But he was still printing money to keep rates from going up even faster. And so it was that money, that big boost in money, that with a lag led to the big inflation spike that we got in the late 70s, early 80s. So up till now, I've always said he's the worst Fed chairman we've had, and made a huge egregious mistake, and it led to basically, unless you live that inflation cycle changed forever, or for a very long time, the psyches. That's why we had a 40-year-long disinflation cycle, because every time inflation lifted its head, every cycle, people reacted very strongly and said, we can't let inflation break out. And so it was knocked back down, and we ratcheted down, talking about lower highs and lower lows. Inflation went through that move, and it really was a result of it was a shock to the system to have inflation go up into the 20% area, and they said, well, no, we never want to go back there. And that stayed in both Wall Street psyche, Fed Fed psyche, most economists, businessmen, everybody, that really lived with us for the next 40 years until this cycle. And in this cycle, probably because of the supply chain issues and some other things, it's broken out. Inflation's broken out, and it's causing what we're seeing right now. So Jay Powell comes in, and he knows what Volcker did, and obviously Volcker's legendary for what he did. And basically, by the way, as an aside, what Paul Volcker really did was he took the Fed from what it had been for not just G. William Miller's period, but well before that, for a long time. It was a Keynesian Fed, and it looked at interest rates. What Volcker did was he said, because as I said, Miller was kind of targeting rates and trying to hold them at higher, but steadily higher, and letting money go where it had to go to keep rates in line. And that, as a result, the balance sheet expanded. Money was printed, and you got inflation. What Volcker did was he said, "I'm coming in," and I don't know if he even said he was going to be a monetarist, but it was pretty clear that they were going to take a monetarist approach. And he said, "I'm going to control money, and interest rates can go wherever they're going to have to go." That's why we went from I can remember as a portfolio manager, I think we had a 9% long bond, and in less than a year it was all of a sudden 15%. So because he didn't target rates, he said, "I'm cranking down money. That's the only way we're going to get inflation with a long and variable lag. That's the only way we're going to get inflation under control." And so and that led to a double dip recession in 1980 and then again in 82. But that's now, fast forward to now, and Powell's kind of saying, I'm Paul Volcker. I have to be Paul Volcker here. I'm gonna have to be giving you tough love. I've got to tighten down. And I think that's why it's easy. And I get in trouble because on Twitter I'm Paul's biggest critic. But when everybody, a lot of retail people come on, and not even retail, others, and start calling him an idiot, I go, Paul, Paul's a very smart guy. He's a lawyer, not an economist, and he's a private equity guy, not a market guy. So I have my criticisms of what he's doing and what he's done, but he's not stupid, and there is a reason he's doing what he's doing. And it's easy if you don't really understand the whole what underlies monetary policy and how it works. It's easy to just buy into the narrative and say this guy doesn't know what he's doing. The Fed's a bunch of idiots. They aren't that, but they do. Even though they give lip service to long and variable lags, they don't really. I don't think they really understand those lags, and they are looking at data and trying to bring. It's a huge mistake to try to target inflation, say we'll continue the course until we see 2% inflation. By that time, you've long gone past the time that you should have reversed yourself. So that's the problem. Is he's staying the course on the tight side for what he thinks are good reasons. He understands, just like people have understood for 4 decades, that if we don't conquer inflation now, it could be much worse later. So that's what's driving him. It's just he doesn't understand that by staying too long, and because of the leverage in the system, this could be the biggest policy error in history.
Agree. Well said. Keynesian versus monetarism is a key concept, right, in itself. We could have a whole podcast on that. Keynesian advocates deficit spending as a way to stimulate the economy, and they want government intervention. And while monetarist looks at the money supply, and to me, inflation is everywhere and everything. result of the money supply. And as you increase the money supply, and it's funny, my 8-year-old son at the time, he's now 13, said, but if you increase the supply of something, doesn't that bring down the value? And it's like, to me, it's such a basic concept that, as you keep increasing this money supply, it brings down the value, fiat debasement, and, our value goes down for the dollar. I mean, I think that's common sense. And then the lags. Lags are so important. And in my opinion, they're over tightening now based on such lagging data. So well said. I guess I'm so honored to be on the same page as you. I love your experience. There's nothing more valuable than you having lived through it. And I respect you so much, David Hunter. Amazing your recollection of history. And it all comes down to cycles and patterns. And I agree 100% that, we have to look at the cycles and understand the patterns, because cycles are based on human emotion and they always play out in the same way. They're similar. And, they always say history doesn't repeat, but it rhymes. But these cycles tend to play out and they're based on psychology. And, we have recency bias. So like exactly what you said, based on those policy issues and policy decisions made, people base that thinking on the recent policy. So it's the same thing as, in my opinion, we're in a new regime now. And people keep basing everything on this recent past. So I think that, people need to realize, they need to look at the greater picture and look at the secular market and see what occurred. And I love how you go back to the 70s, you even go to the 50s, and then you talk about the 30s. And it's unfortunate that we may have to relive that kind of experience again. But, cycles are playing themselves out. So I want to zero in on this melt up. And I want to go right into this melt up, which is going to be occurring for the next few months, and break it down. We got the why. We know excess liquidity brought us to where we are. And there's, like you said, the bears keep fueling the bull market. There's fear of missing out. There's all kinds of issues playing out that keep fueling this melt up. So what type of levels are we looking at? I thought I heard something about a 7,000. I mean, wow, that sounds intense. And I want to know, what type of opportunities? What is your idea? What's the best thing for people to do with this melt up? Should they be all invested? Should they just go and ride it and then try to get out before the plug gets pulled? What are your thoughts on this melt up, and what do you see as opportunities for sectors?
Yeah, I'm a macro strategist. I'm not a licensed advisor, so I have to walk a fine line and not provide any advice or recommendations. What I can say is that what psychology will do, it's pretty predictable, is that as this thing steepens, as the market, if I'm right and we get a melt up, as it steepens, and let's say we do get, a final surge that takes it up 1,000 points in a month, or anything close to that, or even if we get half of that, as we approach that top, I can say with a lot of confidence that you're going to have as much bullishness as you had bearishness last year. So, at the top or near the top, when I start talking about the bust and the risks, I'm going to be the one taking the heat for abandoning the bull market and people telling me this thing's just getting started. There's a long runway ahead. What are you doing? It's just like at the bottom, everybody was saying it's going a lot lower. You're an idiot. Why are you looking for, the upside? It's psychology, as you say, is driven by the tape. I call it the tape, by the momentum of the market. And as the momentum builds, so will that bullish sentiment. And so people have to guard against that, and understand themselves and understand the whole investment process, or how investment psychology plays such a big role in markets, so that they can guard against getting, because the reason I'm a contrarian is because at tops everybody's bullish, and at bottoms everybody's bearish. In between there's a mix, but so at the extremes, what I want to do is reverse that and be bearish at the top and bullish at the bottom. Obviously I don't, I'm not going to catch the exact bottom or the exact top, but I'm not claiming that anybody can. But what you want to do is understand that as you move towards that top, risks are rising because there's something on the other side of the mountain. And as you move to a bottom, you're getting better valuation, so risks are diminishing as you get farther through the down cycle. So it's important to try to reverse what your natural tendency will be, which is to get caught up in the euphoric move and want to be, say, I'm FOMO. What am I missing? I got to get on board. Gee, if I had done this a month ago, I would have made 20%. What am I doing? I got to get in. If everybody remembers back to the .com era, people were mortgaging, taking second equity loans, second mortgage out of their homes and putting that money in the market near the top, and they lost their shirt. It's you just have to understand psychology. I read a book in 1977, came out in 1977. I was already a contrarian, I was already an investor, but it spoke to me because it was everything I thought. And a guy named David Dreaman used to be have a column in Forbes, and he had a money management firm based on value investing and based on contrarian investing. He was truly a contrarian, and he wrote a book. At that time, that book in 1977 was called, I think it was called The Psychology of the Market. But in his revisions, in the new editions that came along, I think he had several editions. The last one I know of it was, and pretty much the same contents, he just updated, but I think was Contrarian Investment Strategies. A guy named David Dreaman. You can go on Amazon and find it. I think his last edition might have been written in the 90s, but it holds today. I tell every retail investor that they should read that as one of the important books to read, because it really explains very well how big a factor psychology plays in investing and in investor psyche. And if people can understand that, they got a fighting chance against markets, because as we all know, most retail investors scratch their head and say, I don't see the logic of what the market's doing. If you understand the psychology, you can better understand what seems illogical. And certainly one of the big reasons I was bullish when everybody was bearish in 2020, and why I was bullish when everybody was bearish last year, was because sentiment was so extreme on the bearish side. And I'm not a knee-jerk contrarian. I don't just go the other way unless I can make the macro case. But it was very clear that, particularly 3,500 back in October, that so many people were betting on the downside and had acted on the downside, that they were going to have to shift to the other side. The next move was going to be a shift to the other side. So if you go from one side of the boat and you all move to the other side of the boat, it can be a very big move. And it's playing out. You've obviously had a 1,000-point move while everybody remained bearish, from October to now. And I think that's just going to get steeper as we go.
Wow, well said. The market's made up of buyers and sellers. So when you run out of buyers, what happens? And you have the sellers and vice versa. So that's why there's greater risk buying near the top. And as we get closer to that top, as we keep accelerating up, that risk increases, and vice versa on the way down. And it pays to be a contrarian. I read this book, I forgot the author, but he did talk about the tulips and the tulip mania. And I know everyone's heard about that, but it's that euphoria in the market. And it's like human nature to just want to jump in. You're like, oh, I've been waiting too long. And then you end up jumping too late. And you're like, what did I do? And then you end up losing everything. And it's also, they say, buy when there's fear, sell when there's greed. It's that whole thinking, but it goes against the grain. And it's almost like we need to condition ourselves to think different and against what the crowd is doing. And that's exactly why your argument makes a lot of sense, David. I love your macro perspective, which to me is the backdrop for the markets. It's the liquidity. It's what fuels or takes away from the market. I want to go into the bust. And this bust may occur sometime round figure at the end of this year, maybe early next year. And you foresee a potential 80% drawdown, and that's significant. And that would be meaning from the peak, let's say it hits your number of about 7,000 on the SPX. So you're talking about that peak 80% from that, correct?
A peak to trough decline, yes.
Okay, and then it's more of a depression than a recession. So the main drivers of this long-lasting depression will be the unraveling of all this massive debt. Is that the real catalyst of this bust?
It's certainly a piece of it. Let me just clarify. I don't think it's long lasting. I mean, it'll feel plenty long enough because it's probably all of next year, and it may spill into 2025.
Okay.
But the depression, obviously the Great Depression lasted the decade of the 30s. So this is not like that. This will be
good. Oh, good.
2008-9 type thing. The difference between 2008-9 and this is in 2008-9. I don't know if you remember, GE almost went under because they were, the commercial paper market was freezing up, and if the authorities hadn't, if the policymakers hadn't acted fast, you were going to see a domino effect, and that's what a bust is. Once you kind of tip over, and you can't stop it, just one after another. Our banks were insolvent or pretty close, and there were several, and the government stepped in and stopped it. If they had not, we would have seen a bust back then. I think this time, partly because it's so near at hand from the memories of 2008-9 are there, and again, part of that, we don't want to do what we did before and print money. There's going to be a delayed reaction, I think, this time, because I don't think they understand the risk. And so what really, and by the way, I am very particular about bust is the economy and the overall financial system. Bear market is what the term is for the market. So people talk bust and they'll start talking about the market. No, the bust is the economic side of things. The bear is what goes along with, the bear market is what the market does in that bust. So just to keep those terms straight. But I think, again, I think the central bankers and the government policymakers, our politicians, they're all going to be a little reluctant to go back to the same playbook we had in 2008-9 because of what it brought us afterwards. They're going to say, hey, we're trying to avoid inflation. We're trying to bring inflation down. We're trying to not make the same mistake again. And of course, who's been the biggest critic out there of what they did? Wall Street. And Wall Street's going to be right along with them, saying, "Don't do that again. Don't print money. Don't ramp up fiscal stimulus. We can't afford that. You got to take the pain." So I think there's going to be a delayed reaction when this thing starts unraveling. They're not going to step right in and do what they did in 2020, even. So that just the fact that there's a delayed reaction, just because it is going to unravel quickly, is why you can go from containing it to something that gets, it's going to be scary how fast things are going to start unraveling. And again, our Fed is not unique. This is how all the central banks are thinking. This is how most government officials are thinking. It's too fresh in their minds what the mistakes that we made, but they're going to make the opposite mistake of not understanding how fast they have to react. So that's one thing. Again, you have the lags. So even if they do react quickly, you still are going to have to, wait it out because it's going to keep, they'll be able to, the liquidity will be able to solve some of the problems immediately, but other things will just keep unraveling. But if you get an 80% bear market, and I think it'll, it could happen any number of ways, but let's say I would say if I picked a kind of a path I'd expect it to take, you might drop 40 or 50% in one quick move, have a big bear market rally, and 25, 30% that gets you part way back. And then the second leg drops, it takes you all the way down. It could happen in 2 legs, could happen in 3, but it's probably not going to go straight down from top to bottom in a few months. So it probably is something that'll play out over, 6, 7, 8 months, maybe longer. And so it's painful. You're going to get, investors are going to get very discouraged because it's mostly a down market. You'll have, short ups, but mostly you'll just be watching your portfolios go down and down. So all of that plays a role. And then once you get to the bottom, it's going to be hard to buy because just like it's hard to sell at the top, at the bottom you're going to have nothing looking good. You're going to say, well, what if this time it doesn't come back? What if they can't resolve this? What if this lasts for several years? How do you know it's not? So there's going to be lots of arguments for why you probably want to, why you're going to talk yourself into sitting on the sidelines and not taking advantage of the opportunities.
Exactly. It's human nature to do that. It seems that the bust is going to be a catalyst for this secular bear market. Is that correct?
Yeah, the bear will probably lead as markets lead economic cycles. So just like the market's going up right now, we're not sure exactly why. You're going to see some of that in coming months, I think. And just like the bear market last year happened, and then you started seeing some of the bad news unfold over the months ensuing. So markets lead the economy and lead activity. So the bear market could start this year. The bust itself probably could start late this year, but not before late this year, and may be delayed into next year. The thing is, when you're talking about the economy, you can't date recessions while you're in them. You can't, and you're not going to be able to exactly date a bust when you're in it. You'll know when you're in it because at some point, because you're going to see bank failures, etc. But when did it actually start? It's people keep asking me those things, and I go, it's not like a bell goes off and you go, okay, this was the start of the bust. The NBER dates recessions, and they go, usually it's after the fact. And when they date it, it's usually started before you thought it started, or before the conventional wisdom thought it was. So we won't really know all of that until after the fact, probably. But
absolutely,
in general terms, I think the bust is going to be most of next year, and the bear could start late this year, or fourth quarter of this year. And in terms of I don't think I answered your question very well. In terms of what causes the bust, I use a simple equation of massive leverage. And this is leverage like we've never had before. It's far beyond what it was even in 2008-9. We've ramped it up this cycle far beyond, and again, worldwide leverage. So we've got 300 trillion in debt, and in 2000, coming into the pandemic, I think we had 250 trillion in debt. So just in 3 short years, we're up 50 trillion. I mean, again, we throw these numbers around, but that's a massive change in the amount of debt in the world. So 300 trillion debt, quadrillions in notional value of derivatives, and whatever the implication of that is, because again, notional value means the derivative is on the underlying security, and the value of the security is this. The derivative isn't that value, but we've gone from virtually no derivatives in the mid 80s to quadrillions. I mean, and I call derivatives leverage on the markets. Debt is leverage on the system, on the economy, on the system. Derivatives are another form of leverage on the market. And leverage, I learned in business school, leverage enhances things on the way up. So you can buy a house with leverage by borrowing money from the bank. You didn't have to wait until you could pay cash for that house. You were able to use leverage. Um, and while the market's going up, while the housing market's going up, you're saying, boy, I only had to put 100,000 down, and my house has gone from, say $400,000 to $1 million, and I didn't have to spend any more. I didn't have to put any more into it. So it works on the way up. When you get into a bad housing market and the houses all of a sudden fall 30%, you're sitting there going, oh, I'm seeing my house, my equity go down a lot. So leverage works on to enhance on the way up, but on the way down, leverage, and the real problem is if you get over leveraged, as the governments are, on the way down, you run some real risks. Or banks, when they were over leveraged, for example, in 2008, they went belly up. The banks got bailed out. General Motors got bailed out because they had too much leverage for what happened. So leverage, massive leverage, plus a pandemic that caused economic fragility and confusion. So we've got, I think, a lot of the problem today is we had all that money put in 2020 and 21. We had $5 trillion pumped in here in the U.S. We had all those multi-trillion-dollar fiscal packages put in. Checks were cut for everybody and handed to everybody, free money. All those things are confusing statistics today. So you've got problems underlying this system, but you look and say, gee, the GDP is 2%. We're still growing. I thought we were going to be in a recession by now. Well, we would have been, except you have all that money still sloshing around that's kind of allowed consumers to stay afloat and, allowed people to take on more risk, et cetera. So underneath that is fragility. You've got a more fragile system because of what happened in the pandemic. It hit us harder than we know. Underneath it, certainly, a lot of small businesses can tell you how hard they were hit in the pandemic, right? Many didn't make it, others are hanging on by a thread. Employment patterns changed. So there's a lot of things that pandemic caused that are still not, they didn't take us down because we did pump money and everything, but they are making our system more fragile so that when we do go down, it's going to be a bigger down because of that. So that's massive leverage plus fragility in the system caused by the pandemic, plus a historic policy error. And again, talking about the US, it's the Fed, but talking about globally, it's a central bank policy error. They're all doing the same thing. They're all staying on the tight side too long. And so it'd be one thing to make that error if you didn't have massive leverage. But if you've got leverage beyond anything you've ever had before, and then you make a policy error that's bigger than any, that's a big one, it gets magnified. And that magnification is a global bust.
Absolutely. It's a recipe for disaster. And we're all interconnected, multiplayers, and they're all basically doing the same thing. This leverage concept, I love that you brought that up because people need to understand that how leverage looks so great on the way up. You're like, oh, I'm a genius. I'm so smart. I put such little money down on this home and it's doubled, in some places like in Florida, real estate's gone up so much. But on the way down, it's accelerated in the other way, and it's even worse. And the worst is when you're over leveraged and your value, your equity goes far below. It's very concerning. So you take that with all this other unraveling of debt and this recent fragility due to the COVID, and wow. I think most people don't sit down and think like you do, David, and you really think this all through, and it really makes sense. It's almost scary, but it's an unfortunate thing, but we need to be aware. And that's number one, is awareness, so we can properly prepare. And I know you're not an investment advisor, and I don't want to ask you for anything like that, but I just want to know, I just have a series of a few questions that I want to ask in a row. And it's just, How long do you think this bear market will last? Are there any asset classes that you think may be spared? How will the dollar do? Commodities, you already told us about the big commodity cycle that's upcoming. And after this bear market, do you foresee another bull market? It's inevitable. The cycles play out that way. And at what time period do you think that may occur?
Yeah. So assuming again, anybody that follows me on Twitter knows that I have thought this thing could play out faster. So I get criticized for, hey, you started talking about the meltdown, that we might see a top last year or at the end of last year, and how come it's not there? So, that being said, this is my best guess at this point in time. Markets have a way of stretching out, cycles have a way of stretching out. As I say, if the market goes through consolidation before a melt up, it can stretch this out a couple months. So, if you get a 1 or 2 month consolidation of, let's say, a 10% pullback that takes 6 weeks, it just means the melt up is pushed out 6 weeks. So with that being said, I kind of think the melt up happens, by this fall. Tops don't typically go straight to a top one day and then the next day you're straight down. Tops build sometimes over weeks or months. I have no idea how long this top is going to take. It could take, I'm guessing it's not going to take long because, the economy is going to be dealing with, all the policy error. We're seeing this thing move towards recession now. As much as everybody wants to talk soft landing right now, we are moving towards a recession. Underlying this are patterns such as higher delinquency rates on credit cards, such as credit cards being used for necessities. Those are all signs that we're getting late, long in the tooth, late in the cycle. So, that's why I don't think this thing carries for very long. And that's why I think the melt up probably gets played out in the next few months. But let's assume the top doesn't take a long time and that you might top out and begin the downside before the end of the year. I would guess you could be at the bottom next year in the market. You might be there as soon as the summer of next year, or it could take longer. So I wouldn't expect the bottom much sooner than mid-year or after. And I'm by no means putting any kind of time frame on it because I have no idea other than just a general guesstimate right now. But so I'd say second half of next year would be sometime in the second half of next year, and it could be anywhere from July to December would be your bottom. The bust itself will carry beyond. The market will bottom probably 6 months before the bust ends. And so, let's say we bottom next August or September, the bust could carry into the first quarter of 2025. And it could carry longer than that if the market takes longer to bottom. So somewhere, I'd say the bust somewhere between end of next year and middle of 2025 would be kind of and like I said, it's not like a bell goes off and you say, okay, yesterday I was in a bust, today I'm in recovery. It doesn't work like that. It'll be after the fact. We'll date that. It won't really matter to anybody. We bottomed in March of 2009. Can anybody tell me, without looking at a statistic, when did the economy, when was the recession dated to have ended? I can't tell you. I don't remember. It was probably late 2009. But it's not like you really have to worry about that. It's the market you're more focused on. So, and so a bear market, if it starts late this year and bottoms end of the summer, it's an 8 or 9 month bear market. Could it go a year? Sure, it could. Could it go 5 months? Sure, it could. I don't think it will, but that's kind of general time frame. Is I think we bottom sometime in the second half of next year. In terms of commodity, in terms of what will hold up in the bust, there are 3 things I think will. We haven't talked about the dollar, but I'm calling for 80 on DXY, so 80 on the dollar.
Mm.
Currently it's around 100. That's a big drop. I'm calling
Oh,
for
yeah.
that. I'm calling for that pre-bust. Now it may spill into the bust. It doesn't have to coincide with the stock market, so in the next 6 to 9 months, I think you could see, and it could happen in 6 months. So next 6 to 9 months, I think you're going to see the dollar drop from around 100 here, just fell through 100, down to 80. That's a huge move. And then from there, during the bust, I think as the bust becomes more apparent and the world gets nervous, and as the bear market proceeds, I think you're gonna see the dollar become the flight safety trade as usual. We are the country that people feel has the more stable economy, has the more stable system. Recent years notwithstanding, but I do think it'll gain a bit as the flight safety currency in the world, and I think it can go from 80 to 120 or higher. So it could be somewhere between 120 and 140. And again, those are two big moves. If a move down to 80 is from, and it started at 115 a year ago, moved down less than a year ago, down from 115 to 80 is a huge move. To go round trip that and go 80 back up to 120 or higher. And again, I might be wrong, but that's kind of what I expect. So the dollar will be one thing that I think during the bust will hold up. And most retail investors are probably not going to invest in the dollar. So, but just know that that's one. I think treasuries are going to hold up in the bust again, because you have a government guarantee behind it. And despite all the concerns we have about our fiscal responsibility as a government and all things are doing wrong, they still have the printing press, and our government debt is not a problem this cycle. Next cycle, which is the 2030s, I think it is a problem. But this cycle, I fully expect them to honor all, treasury debt. So that's a biggie for any investor, and that covers, 90-day T-bills or T-bills all the way out to the long bond. So 30-year rates are going to go down in the bust. There's not a demand for money in the bust. You have much lower demand for money, and you're going to have money being pumped in. So rates go down in the bust on government guaranteed. Rates don't go down on junk bonds or on investment grade debt. When the economy is falling apart, that means a lot of companies are falling apart or really struggling. So going back to that comment about leverage, junk company, companies with junk debt are lower rated companies that have a lot more debt on their balance sheet. And in good times, they can sustain it, and they know what they're doing. In bad times, if their revenues drop off and they can't cover their debt, they default, or they have to restructure. And restructuring starts, debt holders try to restructure, not public, but private debt holders try to restructure that debt and give them a helping hand to get through it. But in a bust, it's going to be a hard thing to get through. So, companies with a lot of debt are going to struggle. And even pretty good credits are going to see their credit deteriorate. So stick to highest quality, which means government guaranteed debt, meaning treasury debt, or government debt anyway. And I think that will hold up. But below AAA, you're going to see spreads widen, or below treasuries. Spreads to treasuries across the board, I think, are going to widen dramatically. So as they did in 2008-9. So if you get a bust, even if your bond that you bought or a bond fund that's corporate, even if it doesn't default, it's going to lose value, and maybe lose a lot of value as those spreads widen. So and the asset that will hold up in the bust, I believe, is treasuries. And then the third thing is just FDIC insured savings and checking accounts, so bank accounts, because I think the FDIC will be funded to whatever level is necessary to meet the insurance obligations. So any insured account will be, again, that's this cycle. In 2030s, all bets are off. I don't think they'll have the money to do that. But in this cycle, I'm not worried about FDIC insured accounts. And frankly, given what we saw with Silicon Valley and the regional crisis last spring, the odds are pretty good. We don't know this because things can change, but I'd say the odds are pretty good that they're gonna honor an awful lot of uninsured accounts. But I would not be reckless and build up big account balances in banks saying, they'll bail me out. The FDIC you can feel safe with, I think, but above FDIC balances, you just don't know.
Well said. Thank you so much for that. So remaining liquid.
Let me add one more thing, and that is the commodities, because I just want to make
gold and silver.
Well, no, I just want to make clear the commodities, and we'll talk about gold and silver, but commodities in general. I use the analogy of standing on the south rim of the Grand Canyon and looking across to the north rim and thinking it's a short distance across, and you can get there pretty fast, and not recognizing if there's something in between the south and the north rims, meaning the Grand Canyon. So the same thing is true of commodities. I do think we're going to have a run here in the melt-up. Commodities will do quite well, and precious metals will do quite well. But understand that it's not a straight line from here to the commodity super cycle. That big commodity cycle that we talked about earlier, that starts after the bust. Between the melt-up, run-up in commodities in the next few months and the big bull market in commodities in 2025 to 2030, there's the bust, and commodities are going to get hit very hard in the bust. So you can't straight line it and say commodities are going to do so well next cycle, I'm just going to ride them out. Do it if you want to. That's it's as long as you're making a conscious decision, knowing the risks, because you're gonna have to sit on some big paper losses in the meantime during the bust, because for example, I'm forecasting copper to go to $6 before the bust. It's currently 380, 390. That's a big run up. I'm not sure if he'll get there, but that's my forecast is $6 in the next 6 or 8 months. And then in the bust, I think it could fall to $1. So if you just ride it through, you're going to be on a happy camper, I think. And then after the bust, who knows where it goes? Sky's the limit, $20 higher. Who knows? So and I'll use the ones I do feel more comfortable with. My targets are gold and silver. Silver is currently 25. I think it's going to run to 60 here pre-bust, and then the bust could run back to here or below. So could do a total round trip in the bust, and then by the end of the decade, I forecast silver at $500.
Wow.
Again, I could be off by hundreds of dollars, but in either direction. But I think 500 is a pretty good estimate. Gold is currently 1960 and change. I think it can run to 3,000 pre-bust, meaning the next 6 to 9 months, and then fall to probably come back to here maybe. So it might fall back to 1900, 2000, and then from there in the 2025 to 30 period go to 20,000.
Wow. So
that gives you some sense that when I say a commodity super cycle following the bust, that's what I mean. When we talked about oil before, when I talk about precious metals, there's a lot of people throwing around super cycle now as if it's going to go straight there, or that we're in it. I don't think it really starts till after the bust, because you've got to get through that very difficult economic period.
Well said. You're very brilliant, David. I love your thinking and how you outline. It's very complex, and that's why I want to try to simplify it for people that makes sense. The commodities right now they're going to have their run, but then they're going to be affected in the bust and the bear market. And then there will be opportunities again. And like you said, you foresee copper could go down to $1. But then after that, there's that different part of the cycle, which is the 2030s that you talk about being a very difficult time period and potentially a collapse.
The run in commodities is 2025 post-bust.
Post-bust. And then 2030s.
We haven't really talked about the 2030s. The 2030s, we can talk about briefly, but it's a whole segment itself.
Oh, wow. This is so fascinating.
The 2030, the reason I call this a bust and not a depression is because it happens fast and we're out of it because the central banks have a printing press, and because this bust is going to be a deflationary bust.
Yes.
So everybody's worried about inflation right now, but because of that policy error we talked about, I think they're actually, the risk right now is that they've set in motion deflation.
Deflation, yeah.
We won't know it for another year, but I think they've set in motion deflation. So we're gonna have a deflationary bust. In deflation, because of the lags, because of the time it takes before you see the next, if you print money, you're not going to see that effect on inflation for maybe 24 months, 18 to 24 months. So while you're in the bust, if we're in deflation, number one, they're going to say we don't have a choice. We got to, we can't let the system collapse. So they're going to print money like there's no tomorrow.
Yes.
And it won't show up as inflation for 2 years, probably. So in 2024, they can print 20 trillion and save the system. And then by 2026, you'll start realizing that they went too far. And then that will build from there. And by 2030, like I said, you could see 25% inflation and the kind of commodity prices I talked about. The problem is you have to square the equation. How if we've got 300 trillion in debt now in the world, I'll just use the global debt, and we do this huge, the monetary stimulus will be accompanied by fiscal stimulus. There'll be, if we have 20 trillion in new money, we'll probably have something close to 20 trillion in new debt. They'll be monetizing that new debt, so there'll be new programs giving people money, anything they can do to get the system going. And that'll be happening around the world to one extent or another. I'm estimating we'll probably have by the end of the decade 450, maybe more, and 450 trillion, maybe more in global debt. So we'll go from 300 to something 50% higher because of the bust. Most of it happening in 24 and 25, maybe 26. Looking just at our own debt, how we can't afford to service our debt today at 7% or at 5%, right? And with short rates at 5 and long rates at 4, we can't afford to service that debt now, or it's taken up a big chunk. Our interest expenses are almost $1 trillion. It's over $900 billion today. Our annual interest expense on the debt we have. If you all of a sudden, over a few years, take that interest rate up from 5% to 20% on T-bills, and 16, 17% on long bonds, maybe higher. So let's say your choices across that yield spectrum are an average cost of 17, 18%, maybe higher. And at the same time, you've ratcheted debt up another 15 or 20 trillion. There's no equation that can solve that. I mean, there's no solution for that equation other than collapse. So in the 2030s, in my opinion, we default on our debt. I hate to say this, but because I could be dead wrong, but just looking out there in a broad picture, I can see the potential. And again, this is not a forecast because I can't know that. But looking at that and saying, how do if what happens this decade, if what I'm forecasting for this decade happens, I can easily foresee 50% unemployment rate or higher, no unemployment system, no welfare system, very limited Social Security and Medicare and Medicaid, if any. Basically, no government supports, in other words, and half the people in the country out of work. I mean, how that's and again, I'm not saying this to be provocative or try to scare people. I'm saying that what we're seeing, and again, we talked about a secular cycle and a cyclical, the secular markets and the cyclical. There's an even bigger cycle called the super cycle, which is, and I'm talking about the economy and the markets, but it's the super cycle one related to the economy is that period between two depressions, as I define it. So the depression of the 1930s and the depression of the coming depression of the 2030s. You have and what happens in that super cycle is each cycle, each cyclical, that shorter cycle we talked about, each one of those, 74 to 80, 82 to 91, 92 to 2000, 2003 to 2008, 2009 to current day. Those are all those cycles. Every time we've gone through one of those cycles, the excesses get greater. So you have more debt and you have bigger, it's one of these things where it goes up and down, up steeper and down, up steeper. And that's why I'm calling for melt up now, is because we're in the last decade of the super cycle. We're basically at the top of the super cycle in the market, and pretty close on, the economy's, the real rollover in the super cycle in the economy is 2030, but
yes,
or there, but you're very late in something that's been building for 80, 90 years. So each cycle, that's why things get more extreme. That's why it took more money to get us out of the last cycle, and more money that cycle than the previous cycle, et cetera, is because each cycle you're ramping up the excesses, and it's just the nature of you're not coming all the way back down. You're coming down part way and then ramping up again to an even higher excess. And so we're at I call it the end of a Ponzi scheme, basically. So it's been 90 years, or will have been 90 years of a Ponzi scheme from 1940 to 2030. And with no ability at that point, at some point, as we've seen with Madoff and others, at some point that Ponzi scheme reaches a point of no return where it can't continue, you can't keep it going, and then it collapses unto itself. And that's what I think we're going to see in the worldwide system, is basically we've had a great run for 80 years, going on 90 years, and I think it all ends at the end of this decade, or early in the next decade. So what I tell people is just focus on this decade. Don't lose sleep over something. This is a forecast. This isn't an absolute.
Of course.
And secondly, you do have one more cycle, that commodity super cycle, and and all that comes with that. You have one more cycle to get your house in order, and do the best you can in the next 7 years. First, preserving your capital for through this difficult time of a bust, and then managing your money on the other side of the bust, such that you don't you're not gonna have a lot of years, so don't blow it. In other words, don't gamble it. Don't do stuff that if you're right, you're gonna make $1 million. If you're wrong, you're gonna lose it all. I mean, you need to get your both your your investments, but also your debt obligation, etc. Do the best you can. Everybody's in different places, so they can only do what they can do. But do the best you can to kind of maximize this next 7 years in terms of being fiscal conservative and understanding that the good times aren't going to last forever.
They never do. Wise words, David Hunter. This has been amazing. The 2030s is when all bets are off and it comes to an end, because everyone's been saying for many years is unsustainable. And what happens when it's just it ends and it's completely unsustainable. And yes, so the next 7 years, remain liquid, reduce debts, and prepare. I think that's the smart words. I want to ask you about the housing market, and not 2030s, but now in the next few years. What do you foresee? We were already talking about commercial real estate, being hit hard, residential market. What are your thoughts over there?
Uh, Real estate's typically thought of as an inflation hedge, and I'm telling you, you're going to have a huge inflation cycle following the bust. I have a hard time seeing real estate as much of a hedge in this next cycle, because what accompanies that big ramp up in inflation is a big ramp up in rates. So as I said, if interest rates are going to be going, if mortgage rates are going to go, they're currently around 7%, they could get down to as low as 2 or 2.5% again in the bust. But you got the other side of the coin during the bust, which is that the economy's going to be bad, and people are going to be, some people are going to lose their houses, be foreclosed on, and what have you. People that got extended. So in the bust, and your credits aren't going to be as strong. So and people are going to be less anxious to buy houses. So even though rates are down, and that'll be a good thing for housing, the banks aren't going to be as anxious to lend, and people aren't going to be in as good a position to borrow, and aren't going to have the psychology to buy. So I think housing could drop 30% in the bust, because we're at pretty high peaks here. And then I'm sure there'll be a couple of years there where you have rates coming out of the bust will be slowly gaining, but you might still have a 4, 5, 6% mortgage a couple of years out from the bust, and have at least a year out from the bust the beginnings of feeling like the economy is coming around again. So you might have a window of a year or two where you get a nice bounce in housing. I personally think, it's not a given, but I personally think we've probably either seen the peaks. We're going to make the peak this year, is my guess. And so whatever let's say we drop 30%, coming back out of that, you might bounce, 15 or 20%, but not get back to the highs. And I don't know what the bounce will be, because real estate usually, once it's down, it's not like the stock market. It doesn't turn quickly. Usually stays down for a few years. So, you may not see a big bounce, if any, but that's, trying to be optimistic. I think you might get a bounce out of the bust. But as you get later in the decade, 27, 8, 9, 30, mortgage rates are going to be double digit, and then much higher, so it started at 10, 11, 12, and then moved to 13, 14, 15, 16, 17, 18. That kind of a mortgage rate means if you have a mortgage at 5% today, because you got it 2 years ago or whatever, and it goes to 15%, your mortgage payments triple. So housing prices are the inverse of the mortgage rate, right? I mean, generally, one of the reasons we had such a big run up in housing is because rates up until recently went from double digit mortgage rates back in the 80s to, a 2.5 or 3% mortgage rate. And people took advantage of that, and it drove up prices. I just don't think it's going to be an inflation hedge. I think, some areas may do okay, but I don't think real estate is a place where you can say, I'm there because it does well in inflation. I think precious metals will do well in inflation. I don't think real estate necessarily will. At best, I think it may hold its own, and my guess is it doesn't even do that. So, and commercial, same story. I mean, obviously commercials, we got all, again, talking about the pandemic and its effect on the economy. We got we've changed our lifestyle. The need for office space has changed. I don't think it's going back there. So you got excess capacity there. The people in that business, the investors in that business will, repurpose a lot of that space. So for housing or what have you, you'll see things that way. And there will be areas in real estate, that are more to the industrial side that will probably do well. And I think because I expect a big run up in commodity prices in ag commodities, I think farmland probably will be the one area that where you might actually see appreciation in the second half of the decade. I think farmers may be in the sweet spot for a few years.
Absolutely. I agree. Agriculture and people need to eat. And, farmland will always be key. When Bill Gates bought up a lot of farm, not too recently. So, I agree with that. You make excellent points there. You talked about the super cycle, and I just want to touch upon that before I get into your thinking, and then we'll wrap up. And I want you to tell us about this amazing newsletter you have, because I'm definitely going to want to subscribe because I want to stay current with everything that's going on here. This is amazing. I want to ask you about the super cycle. Now, I have read about different ways of looking at these cycles, and some people talk about the 200-year cycle going back to 1789, and that whole time period. What type of super cycles are you looking at?
Yeah, like I don't do time cycles. There, people hear cycle, and a lot of people say, "Oh, Harry Dent or what have you." That's not the kind of cycles I do. My market cycles are tied to economic cycles generally. It's bull and bear cycles, so nothing to do with timing. We've had short cycles, commodity cycles tend to be shorter. So I think the next cycle will be, 6 years or something, as opposed to this cycle, ignoring 2020, really have gone from 2009 or 10 out to now. So it's been more, well into double digits. So those are the cycles I talk about, is the market tied to economic cycles. Super cycle, as I said before, is I define it as the big cycle between two depressions. So depressions tend to happen, they skip generations because, you have to get long past the last depression to make the same mistakes that they made, and it takes a long time to build up those excesses, particularly with all the financial engineering we have today. So basically it's Contrarian might fit into some of that in terms of long cycle, but I'm not even talking Contrarian. It's just really simply that cycle between two depressions, and based on having done this 50 years and following economic cycles, I'm willing to feel comfortable saying I believe we're going to have a depression in the 2030s because we're reaching the end of the ability to kind of keep pushing this down the road. You can't kick this can forever. And so we're late in this super cycle. As I said, it builds up excesses cycle to cycle. So because you come out of a depression, and coming out of depression, people have no debt. They lost their homes. They lost a lot of things. They lost their businesses because of depression, is total collapse of things. And you start over. So you're starting kind of fresh with, not many assets, but also not many debts. And then that builds slowly first couple cycles, and then faster as you move along in the super cycle. And then you get to the end where, like I said, we're at debt that nobody can wrap their head around. When you talk those numbers, we used to talk about how our kids are going to be, saddled with our debt.
Mm-hmm.
That's not even, the debt we're talking about now is, 100 generations out couldn't pay for this. I mean, it's just so far out. So it's just going to collapse. It's just at some point that's going to, bring us all down, or bring the system down. And again, I'm focused on the U.S., but this is worldwide. China has far more debt than we do, or is far more leveraged than we are. Japan obviously has been trying to manage their debt by keeping rates low. And that's another risk, because they're beginning to, they were targeting rates, and just like William Miller was targeting rates, at some point, that targeting rates is pushing money into the system. At some point, you create an inflation cycle that the rates follow, and they can't afford. They can barely afford 1% interest rates, never mind 3, 4, 5% interest rates. So they're in the same boat, but at a much lower threshold.
Wow.
So Japan's another issue.
Yeah, exactly. Wow, there's a lot for us to take in there. Amazing stuff. This is wow, very well thought out. Thank you so much, David. Now, I want to ask about your thinking. Are you a contrarian at heart, meaning that somehow your ideas is always different than the crowd? Or do you see the predominant theme of the crowd, question it, and look the other way? Which is it, the chicken or the egg?
Yeah, I am as I tell people, I'm usually a very lonely contrarian at both extremes. So I'm most comfortable when nobody agrees with me. So if everybody's bullish and I'm bearish, most people, this is a very important part of being a contrarian. Most people, by their very nature, whether they know it or not, are uncomfortable being outside the crowd. They need to be with the crowd. There are varying degrees of it, of course, but I've observed for 50 years and been a contrarian that whole time. I used to pick out people in my various companies I worked for and say, my boss or whoever, say he's a good contrarian indicator for me. Yeah, and it's not an insult. They just, most people are much more consensus, much more. They don't even, they're not thinking about it. They just tend to be consensus. I'm hugely comfortable being the only one with a view, and it's obviously not the only one, but a very lonely view that everybody thinks is crazy or I'm outside the crowd for. But as the market evolves, I have no problem being part of the consensus. If my macro is telling me that's where I need to be, or if as I say, I use technicals, I use fundamentals, I use my macro analysis, I use cross market analysis, and I use sentiment. And if all that stuff goes in and says this is where I need to be, I'm not sitting there saying, well, but that's not contrary, I can't be there. Because I recognize during big portions of market moves, the consensus is right. It's just at the extremes where they're dead wrong. So I don't know how I fit into that spectrum you gave me, but yeah, I'm not a knee-jerk contrarian. I don't say, hey, here's where everybody is and this is where I am. It really depends on my work, but I don't know if I could name a time when we were at an extreme and I wasn't alone. It just naturally happens that I'm very comfortable at the extreme saying, well, look at last year. I mean, it didn't make a lot of sense fundamentally to be bullish, and I wasn't bullish about the next 3 months, but I was saying, this too shall pass, and we're going to have a big, an even higher high. That was insane. It was insanity. People go, we're heading. Even though I was the one that kind of pushed the whole bust thesis, nobody was using that term when I started using it years ago. And I'd have people on Twitter say, I get your bust. I now get your bust, and I agree with it. I don't agree with your melt up. So I was talking out both sides of my mouth, saying you're gonna have a melt up before you get the bust. And when in 2021 I was being told my bust wasn't going to happen. I get your melt up, but I don't get your bust. Well, fast forward 6 months later, I get your bust, I don't get your melt up, right? So the psychology had totally shifted, and I had no problem talking about a melt up, even though I knew a bust was coming, and even though last year looked awful. So it takes, as I say, I look at my total sum of my analysis to reach my conclusions, but very large amount of the time, if not always, at both extremes, I am very contrarian.
Very nice. I think how you fit in there is that you have a special skill set, that you're not affected by the psychology and this human psyche that most people are. And you're able to look at your research, look at your macro with a very objective mind, which is very special. And you're able to look at that data and say, this is how it's most likely will play out. And you ignore what everyone's saying, and it doesn't affect you. And that's really awesome. I love this. This has been awesome. Tell us how people can follow you, because you are definitely the voice of reason here, and I'd love to hear more and follow along this timeline. So tell us about your Twitter, your LinkedIn, and your newsletter.
Sure. Yeah, not everybody will agree that I'm a definite follower or the voice of reason. There are people who still think I'm crazy, but I am on Twitter pretty much every day. I'll field questions and even answer the trolls sometimes. So, but my handle is at Dave H Contrarian. So not David, but at Dave H Contrarian. And there are, as people who are on Twitter know, oftentimes if you have a pretty good following, you're going to have fake accounts out there that take your profile and try to pretend they're you. So just buyer beware. Just be aware that there are plenty of accounts out there that use my profile picture and use my profile. And if you're not paying attention, you can think you're on my site or you're on my feed. So they typically have less than 1,000 followers, and I've got 193,000 followers. So that's how you can tell a difference. And just look for that, because it is easy. I don't know why they do it. Some of them are trying to make money doing it, but others are just nuisance. But just be aware of that if you're following me for the first time. And by the way, their handles will be similar, but they'll change a letter. So instead of Contrarian, they may have an M at the end instead of an N, or they might have another letter changed in there, so that it's easy to miss it if you're not looking for it. And then I do have a quarterly letter that is by subscription, so there's a cost to it, and I don't promote it on Twitter. So I tell people to direct message me, and I'll provide details there of cost and what's in it, etc. And it is quarterly. It's an annual subscription. Comes out quarterly. I write quarterly, as you can tell from this interview. My focus is all longer term, and not trading oriented at all. I don't, my forecasts don't change that often. So if I tried to do something monthly, it'd be way too repetitive, I think. So that's why it's quarterly. And frankly, I kind of personally want people to start thinking more longer term. Everybody can do what they want, but I think there's far too much trader mentality on the street. Your neurons are firing, and you're thinking in terms of the daily news. It's not the daily news that drives the market. Markets discount things well in advance. So if you can change your mindset to more of a longer view, it helps you get through a lot of these periods, because the market goes up and down every day and stair steps its way higher and lower. So it really helps if you can understand that and kind of step back.
Absolutely, the bird's eye view and take a big picture view. You remain open-minded and flexible as the data changes, and that's valuable as well. Thinking different. And that's it. People lately are involved with groupthink, and there's a lot of echo chambers. It's unfortunate, but people need to just think. And you do quite a bit of that. And I love how you've outlined this whole macroeconomic forecasting. It's based on all data, and it makes sense. And I go back to the flat earthers, and it's the person who was able to say, no, the world is round. And that made the difference. And, and I see you as the beacon of light. And even if people don't agree with you, I think it's important that they listen and hear this, because you present such valuable insight, David Hunter. Thank you so much for everything. This has been absolutely fascinating and amazing.
Yeah, thanks, Roseanne. I think I ran on a long time. I'm sorry.
It's okay. I love it. You are brilliant. I love this. Thank you so much.
Oh, thank you.